Welcome to On Investors' Minds. I'm Kerry Craig, a global market strategist here at JP Morgan Asset Management. And thank you for giving us a few minutes of your time to hear about what's on investors' minds and how that fits in with the current views on asset allocation. Now today, I'm very pleased to be joined by Kyle Williams. Kyle is a portfolio manager in our international equities group. While normally based in London, he's out in Australia this week meeting with clients. Kyle, thank you for taking the time to chat with us today.
Thank you.
Now, it is a very opportune time to have you here and on the podcast because we've seen a lot of gyration in equity markets over the last few weeks. A lot of that is linked back to the performance of growth stocks, some of the concerns around AI disruption of business models. But in your role, you focus more on value and a value style in the funds that you manage. And now, sometimes when we talk about styles, we can be drawn to thinking about sectors. So like tech as growth, financials as value. And that means when you think about styles, you're sometimes thinking about a sector bias. Now, I think that's probably a relatively oversimplistic categorization of it. I'd really like to get your view on how you think about defining value as a style, what it is and what it actually isn't.
Of course, yeah. So I think if you take it back to basics, value investing is all about buying something for less than it's worth. Now, that's what we all want to achieve when it comes to going out buying groceries, buying a second-hand car, buying a house. Why would you ever want to overpay for what the asset's worth? And the same thing applies when it comes to buying stocks too. So the reason why value investing has been a very successful style over the long term, and if you look back to the 1970s, value's actually marginally outperformed growth. It's because there's a strong behavioral rationale to it. Markets are made up of human investors who are emotional, and from time to time get overly optimistic about certain regions, sectors, stocks as new technologies come around. And actually the opposite is true too, where people can over extrapolate recent setbacks or negative news flow too far into the future. And it's this which causes prices to diverge from fair value. And one of the key hallmarks of our approach to value investing is that we are sector and region agnostic. So we have no preconceived ideas about what is expensive, what is cheap. We come into the office every day with a fresh pair of eyes and scour the market for opportunities. And in doing so, we find that we really can find those undervalued securities right the way across the board.
So you mentioned that you're agnostic towards regions. Now, a common theme and some of, again, the rotation we've seen a little bit this year has been not necessarily an end to US exceptionalism in our view, but certainly a portfolio rebalancing as people have been heavily overweight towards the US, and you've seen that grow given the performance of the US market. And there's that comparison. So the US has this growth bias, say Europe is more value because of the way the companies are orientated. When you say you're agnostic to the regions, does that then play through to thinking about it's not as simple as saying one market is value, one market is growth? And is that even really a problem when you're looking at, where to find opportunities?
Yeah, great question. So for sure, we think US markets continue to look expensive at headline levels. The S&P is trading on 25 times earnings historic. And of course, that's driven by the exceptional performance of the tech giants in recent years. But underneath the surface, there are still a lot of companies that are trading at a discount to their fair value. In our global value portfolio, we have nearly 2/3 of the fund invested in US companies that we think are undervalued today. And that's from banks, insurance companies, right the way through to healthcare, industrials, even some software companies. That said, we do also think that international markets continue to look very cheap in comparison today, trading at about a 33% discount to the S&P, which is about a 1.5 standard deviation wide event. Now, we're not saying that they are ever going to trade at the same levels, but if you compare it to a historical discount of about 18%, we believe there's a lot more to play for here, particularly now you have the catalysts in place to help that gap close, be that fiscal stimulus in Europe or the corporate governance reform that we're seeing in Japan.
Yeah, those big, longer thematic themes we're seeing through, whether it's the reflation and re-emergence of more growth in Japan or the expectations around the impact of the fiscal stimulus, which is starting to slowly bleed through into the European economy, have been big themes both in terms of our short-term views and also thinking about our long-term capital market assumptions as we capture it within that. there's also a question that comes up a lot, and it's around concentration risks. So we do have these markets that are now being dominated by a few companies in terms of their market cap weight. It's driving the earnings, particularly in the US, but you can look around the world and look at other markets that have that same implication, Australia being a great example. Does that mean, as you've seen the growthier parts of the market start to grow, there's a smaller pond to choose from when it comes to thinking about value investing?
I think far from it, actually. We have a very diversified approach and currently hold about 300 or over 300 names in the portfolio. Given the data-driven approach that we use, we have insights on over 5,500 stocks globally. And we continue to find opportunities right the way across the market in every country, every sector out there. In fact, some of the best performing stocks in the portfolio over the past 12 months have come from names further down the AI value chain, for example. We've been invested in the US memory stocks like Western Digital, Seagate for 2 to 3 years now, but well before they were leading the market from a returns perspective. When we bought into these companies, the prevailing view was that the market was in structural oversupply, and hence they were trading at very attractive multiples. But we thought that was harsh. And sure enough, with all the demand coming through from a data center build out and increasing compute capacity, we've seen a real inflection, both in terms of the volumes and pricing, which has obviously supercharged the growth profiles for these companies. And I think that's the key thing. For value investors, we need to keep an open mind and continue to look for those overlooked opportunities wherever they might be in the markets.
Absolutely. And then you kind of touched on it there around the role of value when it comes to some of these concerns around concentration risks and growth. I mean, is there a natural sort of benefit of thinking about the diversification benefit of value in that environment?
I think diversification is absolutely key. A lot of client portfolios, and forgive me for using a football analogy, have become rather offside with their allocation to quality growth and US growth in particular, be that intentional or not. Adding in an allocation to global value is the perfect offset to that. So if you look at the correlation of our global value portfolio, it's 0.5 versus the Russell Large Cap Growth Index, and we don't hold any of the Magnificent Seven. So if you're looking to take the edge off your growth exposure or put new money to work, then this is a really great way to balance that out.
Yeah, certainly that diversification theme is becoming more important. I mean, you are seeing a pickup in the earnings cycle that does look relatively earnings cycle, but you look at a lot of other metrics, whether it's M&A activity, unemployment rates, profit margins, and they point more late cycle. So it's important to have a bit more diversification in the portfolio when you think about where in the economic cycle you could be. A final question before I move topics on this sort of composition of markets and growth that's come up a little bit. Last year was a great year for private equity exits. So M&A activity, IPOs were all picking up. This year we've got potential for a very, very large year, given some of the private companies that may be going public. This has raised the question about what happens if you get these big companies going into the indices, given that they are growth focused, and if that has any impact on your investing.
Honestly, no. There's a lot of excitement about these companies at the moment, and as we've seen many times before, this can really lead to prices becoming very overextended. The reason a lot of these companies are coming to market is because they need capital. These aren't necessarily the asset-light business models that we've seen in the past. I mean, just look how much CapEx is being spent this year alone, nearly $1 trillion on some estimates. I think the real winners down the line are the companies that can harness these new technologies to improve both their top line and generate cost savings on the margin front as well. And as earnings start to broaden out, this really should be a very positive environment for value investors.
Yeah, certainly we're thinking about the value chain within the AI space, that movement to users away from the sort of architects of AI and the enablers of it in terms of how to position across that part of the market. But let's bring it back to today. I mean, since the fourth quarter of last year, there's been that rotation within the equities reflecting both the shift away in terms of rebalancing in portfolios against some of those exposures. You've seen value up from growth, mainly in Europe, but now so when we look at the US indices, it's starting to move that way. again, it's coming back to this idea around the duration of these kind of movements. Is simply the rebalancing of investors' portfolios? Does that imply there's a finite life to how far this sort of outperformance of value can go, or is it more a reflection of where we are in the economic cycle and the macro backdrop, thinking about where interest rates are going, back away from very low levels, capital becoming more expensive? I mean, what would you point to when you think about the continued outperformance of value, or at least matching the performance of growth?
I personally think it's the start of a new regime. Historically, we've seen value consistently outperform growth when interest rates are at normal levels. In fact, only the only prolonged period where that wasn't the case, which sticks in a lot of investors' minds, given it was fairly recent, is the zero interest rate environment post the global financial crisis. That was a real tailwind for those longer duration growth assets whose earnings profiles are typically further out into the future. But we don't see a scenario where rates are heading back to zero anytime soon. So that's a very positive backdrop for value as a style. But as we touched on earlier, you've also got catalysts today to enable that outperformance to continue, be that fiscal stimulus in Europe, corporate governance reform in Japan, or as I mentioned, a broadening out of earnings growth in the US. So we're very constructive on the outlook from here.
Yeah, I mean, it does seem like it's having a bit of a resurgence and a bit more of a runway to continue in this environment. Particularly, I agree around your points on rates in terms of capital becoming a little bit more expensive. It does feel like inflation is, not problematic, but certainly sticky is a word that we're going to be using for a little while here, and central banks are responding to that, particularly Australia, New Zealand, and some other markets around the world. Just going to come back to the valuation side of things. You talked a little bit about the discounts that were there and how they've moved. I mean, you also talked about fair value. When you think about valuations, what are the metrics you're actually focusing on that? How do you think about fair value for these companies, and where are you finding those best opportunities?
Yeah, of course. I mean, when we think about valuation, the key ones for us are price earnings and free cash flow yield. If you look at market levels, the World Value Index is currently trading on about 18 times earnings historic. That compares to the S&P on 25 times earnings. So clearly an opportunity from a valuation standpoint for the value benchmark, but then you compare that to our portfolio, and we always like to maintain a valuation discount to the broad market and the value index. So today our portfolio is trading on 13 times historic earnings, nearly a 7% free cash flow yield, and a 3% dividend yield as well. So very attractive from a valuation perspective.
Well, it's great to hear there's further opportunities out there. I mean, I think our take from the Market Insights team is this is still an expanding economy. Obviously, there's reasons to be thinking about the volatility, whether it's tariffs, geopolitical risk that could persist, but no big reason to suddenly think about a massive market correction. But building in better diversification in portfolios is going to be key this year, and being more disciplined about how that's approached in the portfolio as well. Thinking back to our year ahead outlook, discipline was one of the main words in there. Kyle, thank you again for joining the podcast and your insights into the market. Pleasure to have you out in Australia, visiting the region as well. To our audience, thank you for listening. I hope you enjoyed this podcast. Please feel free to share with your colleagues or consider subscribing for future episodes.
This content is a general communication being provided for informational purposes only. It is educational in nature and not designed to be taken as advice or a recommendation for any specific investment product, strategy, plan, feature, or other purpose in any jurisdiction, nor is it a commitment from JP Morgan Asset Management or any of its subsidiaries to participate in any of the transactions mentioned herein. Any examples used are generic, hypothetical, and for illustration purposes only. This material does not contain sufficient information to support an investment decision, and it should not be relied upon by you in evaluating the merits of investing in any securities or products. In addition, users should make an independent assessment of the legal, regulatory, tax, credit, and accounting implications and determine, together with their own financial professional, if any investment mentioned herein is believed to be appropriate to their personal goals. Investors should ensure that they obtain all available relevant information before making any investment. Any forecasts, figures, opinions, or investment techniques and strategies set out are for information purposes only based on certain assumptions and current market conditions. and are subject to change without prior notice. All information presented herein is considered to be accurate at the time of production, but no warranty of accuracy is given and no liability in respect of any error or omission is accepted. It should be noted that investment involves risks. The value of investments and the income from them may fluctuate in accordance with market conditions and taxation agreements, and investors may not get back the full amount invested. Both past performance and yields are not reliable indicators of current and future results. J.P. Morgan Asset Management is the brand for the asset management business of J.P. Morgan Chase and Company and its affiliates worldwide.